Welcome back to Deep Mara Academy.
In this explainer, we're going to deconstruct the economic mechanism that connects geopolitical risk to the final delivered price of oil. We'll start by defining what war risk insurance actually is, then we'll look at how its costs are calculated, and finally, we'll trace how those costs make their way through the supply chain to ultimately influence the price you see for energy.
Right, let's begin by defining exactly what we mean by war risk insurance and, crucially, how it differs from standard maritime policies.
Now, this isn't a standard part of marine cover, it's actually a specialized policy, and it's designed to address the very perils that conventional insurance policies explicitly exclude. We're talking about things like losses from conflict, civil war, or acts of terrorism.
And this is really the key point. Your standard policies that cover a vessel's physical structure, so its hull and machinery, and its third-party liabilities, well, they simply don't cover acts of war. And that distinction is what creates the need for a completely separate war risk policy for any vessel that's going to operate in or even just pass through a designated high-risk area.
So now that we've defined the policy, let's get into the mechanics of how these premiums are actually worked out.
You know, it's a very structured process. It all kicks off when a vessel is scheduled to enter a formally designated high-risk zone, what's known as a listed area. These areas are identified by official bodies, like the London Market's Joint War Committee. The shipowner is then required to notify their insurer, and the insurance specialists, known as underwriters, will quote what's called an additional premium for that specific voyage.
This premium covers the direct cost of insurance for a single transit, which usually lasts about 7 days. Now, the percentage you see here might look quite small, but for a high-value vessel like a supertanker, well, that can easily translate into hundreds of thousands or even millions of dollars for just one trip.
So the logical next question is, where does that cost go? Let's now have a look at how this insurance expense gets passed into the rates that are charged for chartering a vessel. This is absolutely crucial. The cost of this premium isn't just absorbed by the shipowner. Instead, it gets passed down the supply chain. The shipowner pays the underwriter, and then they incorporate that extra cost into the freight rate they charge to the charterer. That's the company hiring the vessel to transport its cargo.
And as this quote really highlights, that increased insurance premium becomes a direct part of the overall voyage cost. And this, in turn, is directly reflected in the charter rate, the price that's paid to hire the ship.
Okay, let's follow this chain just one step further and see how these increased freight rates ultimately have an impact on the final price of oil. This brings us to a very important distinction we need to make, the difference between the global benchmark price of oil, like Brent crude, and the final delivered price. You see, the benchmark price reflects global supply and demand for the oil itself, but the delivered price includes all the costs needed to get that oil to its final destination, and that includes transport and insurance. It's this final, landed price that's directly affected by these war risk premiums.
This slide really lays out the whole chain of events quite clearly. It begins with a geopolitical trigger, which increases the perceived risk. That leads to the designation of a listed area, which in turn causes the insurance premiums to rise. Those premiums are then passed on as higher freight rates, so naturally, the cost of transporting oil goes up, and the result is a higher landed price for whichever region is importing the oil.
So, this brings us to the actual scale of the impact. In this section, we're going to put these costs into a bit of context and look at the limitations of their effect on the wider market. This table really helps to give us some perspective. Let's imagine a very large crude carrier, a VLCC, valued at around $100 million. A 2% war risk premium on that works out to $2 million. Now, that's a huge amount of money, of course, but it represents a very small fraction, less than 1%, of the total value of the oil cargo that's actually being transported. So, what the evidence seems to show is that war risk premiums act more as a regional cost factor rather than being a primary driver of global benchmark oil prices. They tend to create price differences between various geographical markets. The major caveat here, though, is that a severe and prolonged crisis in a critical choke point, say the Strait of Hormuz, could absolutely have a much wider impact on global prices. And here is the tangible impact, on a per-barrel basis. When you spread that extra insurance cost across the 2 million barrels of oil on a supertanker, it typically adds somewhere between $1 and $3 to the delivered cost of each barrel. This is the direct mathematical outcome of the economic mechanism we've been outlining. All right, let's put all the pieces together and just summarize the complete economic process from start to finish.
So to sum up, war risk insurance acts as a direct financial mechanism. It translates geopolitical risk into a quantifiable cost right inside the energy supply chain. It doesn't typically drive the global benchmark prices up or down, but it does influence regional price dynamics by increasing the final delivered cost of oil for the importing nations.
We'll just leave this technical appendix on screen for a moment, which provides a useful reference for the key figures and institutions we've discussed. Thank you for listening, and we look forward to seeing you again soon. If you derived value from our content, please consider sharing it with the world. Goodbye, and continue learning.